So these are the conclusions. However we use the land, the derived nature of the demand determines how much money we've got to buy the land. Use, in planning terms, the use classes, determines the value of the land. Use determines value. What we've also got is that landowners think they can get more for the land because there's always a hope value. They're always wanting to hold land back. Developers have land banks, thousands of plots of land, some with plan permission, lots without it. They've probably paid very small sums of money, mainly because the people who have sold the land are distressed landowners anyway and wanted to convert their holdings into cash. Or they've actually enticed the landowner to give them the right to own the land in 2 or 3 or 5 years' time, what we call a land option. So they pay the current landowner, say 20,000 quid, to say, okay, we'll give you that. That's the price of you not selling it to anybody else. And we'll come back to you in 2 or 3 years' time, and we'll pay X plus for it. And they'll sign an agreement. And the developer will be in control of that agreement because either they'll pay the sum or they won't. But they've paid something up front to keep the landowner happy. So that's how they build up their land banks. And then they'll sell the land if they don't need it, if they bought it, and they'll sell it to another competitor, or they'll share some of the land because it's too big and they want to create sort of a competitive market in quotes. So that's how the land market works. They don't necessarily are the end developers, but there are lots of intermediaries. The gasworks people, your consortium, it's been made up of lots of different landowners, largely driven by National Grid and the Berkeley Holdings Company. National Grid have sold their interests in all the gasworks in the southeast of England. They're a nationalised company. Barclays paid over £500 million for 27 sites, which were in a joint venture between National Grid and Berkeley Holdings. So all those sites now are 100% owned by National Grid. In Company's House, it's called St. William's LLP, Limited Liability Partnership, a wholly owned subsidiary of Berkeley Holdings PLC. So it's really important that you understand what they're paying for the land. It has nothing to do with the fact what it's worth. They've just basically come to an agreement as to what they're going to pay the previous landowners. And that price has nothing to do with viability. Whatever they paid has no influence on whether the site is viable or not. And that's got to be really recognized. In fact, some of the sites that you're struggling with are worth, I was going to say bugger all, they're worth negative, they're a liability, because the service costs of getting that site up to a point where it can be developed is significant. And one of the things that you will notice, and this is the last thing, Charles, before we have a break, is that they use language in an incorrect way. They use terms like abnormal costs. And I don't know what you think that means, but there is a clear set of instructions as to what is meant by abnormal costs. And that's set out in the guidance written by the RICS, the body that governs how chartered surveyors are supposed to operate and carry out their main job, which is to carry out development appraisals and viability. In practice, however, they use abnormals to differentiate between greenfield sites and brownfield sites. And they say any costs which they incur, which would not be incurred by a greenfield site, is an abnormal cost. Well, that's tosh, that's nonsense. That's not in convention with the definition and the guidance written by the RICS. If you actually look at what the owners of the gasworks sites, they know very well what they bought because they've already done many, many site investigations. And an abnormal cost is a cost that's not known at the time of development. Well, they know fully what the costs are going to be because they've got site investigation reports that inform the status of their sites, and they've commissioned reports to say, well, how much will it cost to clean up the site? The reason why they do that is because they can claim land reclamation tax relief if they do it properly. And that tax relief is really incredible. It says that if you spend £100, you get £150 back on tax relief on your profits. So if you're spending £10 million cleaning up the site, which is the claim of Berkeley Holdings PLC down in Brighton, they're going to get 1.5 times back that figure, which they can set against their profits, and therefore they don't pay the tax. So that might be one of the reasons how they make supernormal profit. A simple tax relief benefit. However, when you look at their financial viability assessments, they say nothing about the tax relief. They're completely silent. It's not even in the calculation. So we have to reveal it for what it is. So it's that sort of knowledge of the methodology and the detail and the sort of issues which are not reported that give you ammunition to say that what's been is reported is not only wrong, but it's misleading.